our themes for this year is one of selectivity. And I know that sounds kind of very generic, but it comes from this notion that we think that we're still late cycle, which just means that very low unemployment, interest rates relatively high. Yes, the Fed, might be extending the duration of this cycle because of the interest rate cuts. That's a different debate.
Yep.
But that, that eventually, you'll see, a pickup in unemployment. You'll see like I said, still not a call for the first half of 24, but a late cycle nature to this economy, which just necessitates selectivity. It necessitates good balance sheets, good return on invested capital, good free cash flow generation. Right now, we're seeing a lot of junk rally because of that kind of retirement of the higher for longer risk. But if you see any doubt creep in whatsoever that the Fed's not going to deliver on the 3 rate cuts, and the bond market has 6.5 priced in. So if that doesn't happen, that's where you could see a lot of that junk give up a lot of its recent gains, just like we saw, the small cap rallies this year, and speculative growth rallies this year, 45% rallies gave it all back up. And that really tells you, that sort of late cycle nature of things. So I'm not saying those pockets of the market can't do well. A lot of them very cheap, coiled springs. They can have big runs. They're beta, like high beta. However, I think that being very disciplined around valuation and keeping them on a short leash, knowing you're there to effectively rent the position, not to own the position, would probably be a prudent thing to do, which of course comes with all sorts of tax consequences.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. By many calculations, the stock market has returned to rich valuations. Following one of the best Novembers in market history, and now juiced by fresh optimism for rate cuts, now 3 of them in 2024, how valid are concerns that stocks are becoming increasingly overpriced and a pullback is warranted? To find out, we have the good fortune to talk today with Cameron Dawson, Chief Investment Officer at NewEdge Wealth. Cameron, thanks so much for joining us today.
Thank you for having me.
Well, hey, it's a pleasure to have you on the channel. This is the first time I've ever interviewed you, so I'm so glad we could make this happen. I'm so glad you could be one of the new faces here on one of the first faces here on the new Thoughtful Money channel. So thank you for coming on for doing that, Cameron. A lot of questions here for you, and as I sort of referenced in the intro there, we've had an interesting curveball this week with the surprisingly dovish guidance that the Fed offered this week and the market's response to that. Before we talk about that specifically, if I can just start with the more broad question I like to ask at the beginning of these conversations, what's your current assessment of the global economy and financial markets?
Yeah, I think if we're starting with the economy, it's one of continued resilience. We go back to the beginning of 2023 and consensus estimates for GDP growth for the US were at just 0.25%. We're now well over 2.5% for consensus estimates, are getting even further up. We had Atlanta Fed GDP now just print today at 2.6%. So that's above trend. That's after an absolutely gangbusters quarter in the third quarter. And so what we're still seeing is, yes, there's signs of fraying. There are signs of things around the edges. You could point to different pieces of data to say there is pockets of weakness, but they're not big enough, they're not sharp enough, or they're not meaningful enough to derail the continued growth of the US economy. They're not enough to derail the employment market, which of course we know drives consumption. When people have jobs, they spend money. And so the end result is that we're continuing to chug along on growth. And I think the biggest question that is probably on all investors' minds, and maybe incrementally less on the mind of the Fed, according to this week's Federal Reserve meeting, is that does that better growth come with the risk of renewed inflation? And we have been in this period over the last few months where growth has been a lot better, but we haven't had inflation. Is that because of productivity? Is that because of the adoption of exciting new technologies? Or are there other drivers and dynamics that maybe we shouldn't extrapolate what's happened over the last couple of months into the future? I think that will be a really key debate as we go into 2024, meaning that if you see a reacceleration in inflation, the pricing of the Fed is going to be whipsawed around just as it was in 2023 and 2022 for that matter. And then from the growth perspective, we continue to see signs that at least through the first half of the year, we're unlikely to have that recession. And we'll continue to assess the dynamics and see if it's a second half of 24 risk, or maybe it's a 2025 risk. Now that's for the US. You asked about the global economy. And what we do see is more distinct weakness, certainly out of places like Europe, and even in places like Canada as well, where you actually have a far more interest rate sensitive kind of economy, meaning that you have more floating rate debt, whether you're looking at mortgages or you're looking at bond markets that tend to be more about bank loans, which are floating rate. So meaning companies feel the pinch from higher rates in a way in Europe a lot more than they do in the US. So there certainly are signs of things like slowdown in Germany and other pockets within Europe. And that likely means as well is that you have the potential for an easing cycle within those economies. You kind of have to have this offset. And I think the one key thing to observe is that not all easing cycles are created equal. And there are some easing cycles that we've had over the last 40 years that have been good easing cycles. You're easing because inflation is falling, at least that's what the Fed is trying to do now, or because there's some fears about growth, but really growth isn't that much of a concern. You have times like 95, 98, 2019, all times when easing was good. But then, of course, you have times like 2000 and 2008 and 2020, for that matter, where easing was bad. So if we get the easing, is it good easing and we hit new all-time highs in markets? Or do we get the easing and it's the bad easing and the Fed's cutting for kind of an uncomfortable reason? That's probably a question more for 2025 as they're talking about the recession dynamics. But I think that we always have to keep in our back of our mind that be careful what you wish for kind of scenario.
Mm-hmm. All right. Great kickoff to this. I've had a couple of interviews since the Fed news came out. And a little bit of either like, Paul certainly projects a sense of being pleased with how things have been going, and he's projecting a sense of like, yeah, it looks like we're winning the war. We're not going to declare victory just yet, but things are going along the course that we would like. Therefore, we're much more likely to certainly cut next than hike again. I mean, he didn't say it obviously, but I think the signal he was giving was we're done with rate hikes. Yeah. And of course, with the Fed dot plot and their guidance, that now the expectation is for 3 rate cuts in 2024 when it was only 2 a month or 2 ago. So on one hand, they're projecting a sense of confidence. I have heard sort of the other side of the story, which is like, hey, the economy is actually like doing okay here. And why are they going to cutting sooner than they've been projecting? In fact, just like 2 weeks ago, they were saying they weren't even thinking about talking about rate cuts. Does the Fed know something that we don't, that they're not letting on about? Like perhaps are they more worried than they're letting on? I'd love to get kind of your thoughts about that. But if we can, in your answer, how surprised were you by this week, and does it change your outlook in any meaningful way?
Yeah, I was surprised by the degree of dovishness by the Fed. It's interesting because I had spoken to Neil Dutta, who's the chief economist over at RenMac, a few days before and then the day after. And I remember he said to me, people shouldn't be surprised by big pivots by the Fed. They've done this all the time. Powell said he's not going to go 75 basis points. They're not considering it. And then lo and behold, he goes 75 basis points 2 weeks later, back in 2022. So at the end of the day, we probably shouldn't be that surprised. But to your point, it's interesting. You go back to the December 1st speech he gave when he said, we're not thinking about talking about rate hike or rate cuts. And in that, he said, rates are restrictive. And so economic growth is slowing. Now, it's a question of slowing from what? Yes, slowing from the third quarter where we had this huge, well above double the potential growth rate or kind of the average growth rate kind of quarter. So yeah, of course you would slow from that. But, when we look at the data that he had going into it, the Atlanta Fed GDP now was sitting at, below 1.5%. So maybe he's saying, yes, here's the evidence, you're slowing down. Well, as we mentioned earlier, that got revised higher to, 2.6% today on the back of the stronger retail sales data and other components. So I think it's really hard to make the argument that they're cutting because they're seeing distinct weakness. The Fed has never been good about looking into the future and saying, oh, yes, there's going to be this economic weakness that will come. They tend to take what has recently happened and extrapolate it. Now, of course, they did try to predict the future with the whole transitory business, which obviously didn't work out. But, you've had Powell now effectively cast off all of the other assertions he was making back over the last couple of years. The whole history warns against cutting too soon, evoking the memory of Arthur Burns from the 70s and stop-go policy, saying that we must get rates to a restrictive policy or level and keep them there, in quote, for some time. And that, that you have to get in and keep rates in the higher for longer camp. You just threw that all out the window. And so, obviously the first reaction by a lot of people is to go conspiracy. It's an election year. They want to, they want to support the economy.
He's getting pressure from Biden. Yeah, all that. Yep.
And that could very well be true. I mean, we go back to late 2018, and there was a lot of questions about, in that December 2018, if Trump was kind of pressuring Powell to do the pivot that he did, after markets melted down on Christmas Eve of 2018. So I think that is, likely a component of not wanting there to be a recession in an election year. And I think the other question would be is that, would we have a recession if they didn't cut rates? Is the economy about to hit a refinancing cliff, where you have, now people actually feeling the pressure from higher rates? And is there risk that growth would slow materially and unemployment would go up materially if they didn't cut? I don't know if that's the case. You don't have a lot of evidence for that kind of relationship yet, but clearly that's on the Fed's mind. So if there's anything, that's the thing that they know that we don't know, is that if they didn't cut, we would have a recession. But at the end of the day, the equity market is kind of telling you that's not the case, right? Earnings estimates aren't coming down. Equities are roaring, going back to very, very extended valuations, with this idea that we can have our cake and eat it too. We can have liquidity, we can have an easy Fed that helps boost valuations, and we can have a strong economy that keeps earnings resilient.
Okay, obviously that's what the markets are hoping for, right? I think a lot of people, and I'll put myself in this camp, are still scratching their heads saying like, what changed since the beginning of December, right? From we're not even talking about rate cuts to this guidance here. And one question I want to just sort of put into that is, financial conditions have been easing.
Yeah.
Right. So as the Fed has been trying to kind of tamp down animal spirits, the markets have not been helping him. Right. And so, he's had this market that's been really just ready to discount everything the Fed has said and take it higher. And the whole year, Powell has said, nope, I'm not pivoting. I'm staying higher for longer. The market has said, I don't believe you. And every time the market's had to move its benchmark, right? But still, it hasn't really mattered, right? Asset prices has powered higher. Up until this past week, I thought that was probably pretty frustrating for Powell, right? But he, to a certain extent in this 2-week period, he went from continuing to sort of tell the markets, nope, you're not going to get what you're looking for, to basically kind of saying, yeah, I'm going to give you what you want. And if the markets are doing fine, I mean, if the economy is doing fine, I wonder why he doesn't take the opportunity to be tighter for longer. He's always said, hey, if we're going to err, let's err on the side of tightening too much because we know how to fix that, right? We know how to reverse that and do easing and whatnot. It gets harder if inflation gets away from us. So I'm just curious, do you have any sense for what might have
changed? So I think let's go back to the beginning of this year, which is there was a really peculiar interview that Powell did in, I believe it was February or end of January, early February. And Powell was asked about financial conditions, which had eased really materially coming out of the October low.
Yep.
Yields had fallen, equity valuations moved up substantially, credit spreads had narrowed quite a bit. And all in, financial conditions were at easy levels that we hadn't seen since the start of 2022 when they were tightening policy. Actually, financial conditions were easier at the beginning of this year than they were at the beginning of 2022 when Powell was saying, we need to get financial conditions tighter.
Right. And he had done all that hiking and tightening during 2022. But as you said, financial conditions were even easier, right? Yeah, exactly.
And he responded in a peculiar way, which is he said, oh no, financial conditions are much tighter today than they were back at the beginning of 2022. And everybody kind of looked around and said, what are you looking at? And what he was looking at was an extraordinarily narrow definition of financial conditions, which is just real interest rates. Meaning that the financial conditions indices that we look at, and we know that the Fed looks at it as well, include equity valuations, credit spreads, level of interest rates in the short and long term, the dollar, and some have some other added components to them. And what that captures, to your point, is that when you have these broad financial conditions indices, it does capture the wealth effect. It captures the role that rising asset prices have in consumer spending.
Right.
And what's funny is that actual wealth effect is one of the express purposes of quantitative easing. When they first initiated QE, you go back to the original justification and assessment. One of the ideas was that you would push people out the risk curve. You'd get people to start investing again. That would then allow people to, and you do that by suppressing risk-free interest rates. As you get people to invest again, that boosts the wealth effect and that boosts consumption. One of the best analogies as to why QE would boost consumption in this really kind of like roundabout way is from Mark Blythe. And he talks about, he's an economist, and he talks about this idea of that if you're trying to fill a glass of water effectively through QE, what the Fed did is that they put the glass of water in the sink, but then they flooded the house and said, oh, hey, look, the glass of water is full, not, mentioning that the rest of the house is flooded.
Yeah.
And so, I think that narrow definition of financial conditions that Powell adopted, being just real interest rates, ignores that whole wealth effect. And we know that contributed to the inflation we had in 2020, 2021, and started 22, where the wealth effect was so huge that you were seeing inflation in things like cars and houses, kind of feeding on itself in this speculative and risk on fervor. So I agree with you, kind of where I scratch my head and go, what's the purpose and the goal that you accomplish here? Because we do know the biggest risk in them doing this, I think the most detrimental downside for them pivoting too soon is one where you have a repeat of Greenspan cutting in 98 and you have a huge speculative bull market like 99 and into 2000. And yeah, a lot of people made a lot of money, but also a lot of people lost a lot of money. There were people who were locked out of investing, got so burned by investing that they stayed out of it for a generation. Also remember that when you hit that new high in 2000, that ultimate high in 2000, it took you 13 years to make a new all-time high. So financial bubbles are horribly destabilizing for long-term returns and long-term investments. And I think if we were to say what's the biggest risk that you would have, is it's in two stages. You get a bubble because you get this speculative fervor that comes back, you get a melt up, valuations go to crazy levels, and then you get a crash on the other side. What that means is that you kind of have to be impartial in the beginning. You can't beat them, join them, but just be extraordinarily resilient or resistant to narratives, because there'll be a lot of narratives that say, oh, of course we're going to trade at X times earnings, right? Because we're the best economy in the world and AI, and you'll have every story to tell you as to why it makes sense. But when you look out on a 5-year plus rolling basis, it could be pretty dangerous. That's not our base case, but I think we have to see that as a higher probability today than it was going into this Fed meeting earlier this week.
Okay, that's really interesting. Okay, you mentioned like several things I wanted to talk about, and you may recall from the intro to this, I talked about how markets had been already pretty richly valued, and then they vaulted higher after the Fed meeting. So when you look at, you talked about what happened leading up to the 2000 market collapse, and similar in 2000. In fact, when we look at the past recessions that folks watching this have lived through, most of them occurred after a pretty, aggressive rate hike campaign by the central banks, and then it plateaued for a bit. And then really right just as the rate cuts started was when the economy started falling into recession, and the Fed was cutting down, clearly in rescue mode at that point, and the markets in most cases had pretty substantial corrections as well. So from a simplistic standpoint, you can look at that pattern and say, oh my gosh, like we seem to be perched right there on the edge of the cliff at this point, and this is right where they start cutting, and this is where everything sort of falls off the cliff again. Who knows if that's going to happen? I don't know. We can say we're starting from a position where assets are richly valued by most metrics here, and I know that you have relatively recently talked about assets having moved very far very fast, and so I'm curious to get your thoughts about that. Before we do though, you talked about the wealth effect that QE is supposed to generate. We have been in a tightening regime over the past year and a half or so, right, since the beginning of 2022. But when you look at liquidity, when you look at measures of liquidity, it's been net positive in most cases. It declined through 2022, but sort of bottomed in October, and hey, no big surprises. Liquidity started to recover, the market started to recover. It has largely been rising this year. And so we're in QT, but it's not, it's really maybe more like stealth QE, and that may explain a lot of the market's activity this year. So you're sort of nodding a little bit and smiling as I'm saying this. Yeah. I'd love to get your thoughts on this. And, does it almost make the Fed saying, yeah, we're probably going back to rate cuts next year, sound like we're going to do QE on QE? Like we've kind of sort of, I think a lot of people are probably don't realize the liquidity story, and have been thinking we're in tightening. Are we really in tightening, or like I said, are we really in an easing regime that's masked as tightening?
Yeah, and liquidity is in the eye of the beholder. So there's so many different ways to define liquidity, but we can do these broad ones where we look at things like Fed balance sheet, reverse repo, reserves at the Fed. And what you can see is that these kind of patchwork measures of liquidity declined really sharply all through 2022. They rose in 20 and 2021, of course, during the Fed super stimulus. They contracted in 2022, and to the surprise of many, including ourselves, they expanded in 23, despite the Fed still doing QT, despite the Fed still raising interest rates. The dynamics around why that would happen does have some relationship not just to monetary policy, but also to fiscal policy. There are arguments that as the Treasury has funded itself with bills, so really short-term debt instruments instead of bonds, coupon bonds on the longer term, that this has actually added to liquidity and made it so that way that's found its way into the market, and it's kept longer term interest rates from going maybe as high as they need to. There will be people who will argue that the Treasury has to go back to more coupon issuance next year, that they can't keep doing this bills business. And the end result is that you could actually see liquidity drain next year. And wouldn't that be an interesting paradox where we all thought that 24 would be the year of the Fed's cutting rates? Of course, liquidity is going to get better. You could, I think a wild card scenario would be one where, because of Treasury funding, we're still running record peacetime deficits that are not in a recession at
record wartime deficits, you meant,
well,
right? Well, wartime level deficits in peacetime.
In peacetime.
Yes.
outside of a recession, we've never seen anything like it. And that, of course, has to be funded. It'll be slightly less bad next year, but it still is near a record, meaning it's unprecedented. And isn't it interesting that now you have stimulative fiscal policy and stimulative monetary policy at the same time as that you're still near 50-year lows in unemployment?
Hmm.
So that's a lot of stimulus. And on a year-over-year basis, the fiscal impulse does slow down versus 23 into 2024. But I think it is an interesting thought experiment. And I think that there's a few people out there on the street who have great perspective on this of, what does liquidity do next year? Because here, the thing that we can observe is that valuations are very correlated to liquidity. And valuations mostly for growth stocks are very correlated to liquidity. They're less correlated to interest rates. And that's how, if we look back, if you had asked me at the beginning of the year, will growth stocks re-rate by 45% this year while you see real interest rates go up to well over 2%? I'd say no, there's no way.
Yeah.
It doesn't happen. That's not the relationship. The reality is it's not real interest rates. It's not interest rates. It is liquidity. And so having a view on liquidity probably is the fulcrum to every single call that happens next year. It's kind of an unsatisfying state to be in, that we live and die by this. But I think given the leverage in the system and it is a liquidity driven market, I think we have to be very aware of it.
And I've only really half joked that, I do several of these interviews a week and we talk about all sorts of different macro and technical indicators and all that stuff. And I sometimes say, should we just throw it all away and just watch liquidity? Is that really the only thing that really matters here? And as you talked about, even if you decide to do that, it's tough because there's all sorts of different ways that different people measure it. But I'm curious, saying that it should be the fulcrum of an outlook, what is your outlook for liquidity going forward from here?
I think that I don't know. I'll be perfectly honest. I do not know. I don't know if the Treasury has the wiggle room to continue with the bills issuance and if that can actually continue to add to liquidity. I think the Fed will continue to do QT, but that's been completely offset by reserves in other places. Maybe what we find is that, as interest rates fall and people get reinvested and money comes out of money markets, that could have some dynamics on liquidity, but it's something that we're still working out, a way to predict. I mean, it caught a lot of people flat-footed this year.
Mm-hmm.
And I think a lot of people will argue that it doesn't matter. At the end of the day, earnings estimates for growth stocks, mostly the Magnificent Seven, were up a lot. Growth stocks grew earnings by 160% this year. So, liquidity be damned. You still have great earnings growth, but I think it's something that we can't ignore. Mostly when you start the year at such a high valuation, and we're trading at 19.6 times forward earnings. And the only time that we've traded above this level, we briefly touched 20 times in July. But outside of that, the only times we've traded above that level was in 2020 and 2021, and then back during the tech bubble. And 2020 and 2021 were, of course, liquidity-driven markets. You also had earnings which were depressed in 2020, and they grew then 50% in 21. So you put a big multiple on those earnings. But real interest rates were negative 1.5%, balance sheet growing $5 trillion, money supply growing 30%. So it's a very different liquidity environment than it was back in those times. And the best argument that you could make as to why, people make two arguments as to why you could get back up to those multiples. A paradigm shift in technology and consumption or a composition of the index, and comparing to history just doesn't make sense anymore. That one's a little hard. It's a very this time is different kind of argument. Remember back in 2021, Case Shiller, the Shiller PE is published online. You can pull it up. And Robert Shiller puts out a note that says, stocks aren't overvalued, even though my Shiller PE is at the highest valuation since the tech bubble. But don't worry, stocks aren't overvalued in 2021 because interest rates are so low. and saying, oh, well, it's the earnings yield and the spread, right, over
Mhm.
interest rates. So the cyclically adjusted equity risk premium. And of course, that was incredible top ticking on valuations, right? They plunged over the course of 2022 as liquidity contracted. So, the fact that in order to get to your upside calls, and this could happen if we have that bubble, right? If we have that speculative melt up bubble, you could see valuations completely disconnect from fundamentals. And in that scenario, what you say is, if you can't beat it, join it in the short run, but realize that forward returns are going to be really ugly in a forward 3 to 5 year basis, simply because valuations will have become so extended. You pull everything
You're
forward.
just pulling everything forward. Yeah, exactly. Okay. I'd love to talk with you in a second about, how you think folks can sort of plan for that, should that indeed happen, or at least surf it as it's going on. Real quick, back to liquidity, just your thoughts on two other things. Curious just if you think I'd love to get your sense of how material they may be. One is the reverse repo program has been contributing to liquidity, and it's draining down at a pace where folks say at the current trajectory, it should basically be exhausted by maybe the end of Q1 next year. So I'm curious if that program is no longer contributing to the liquidity situation, if you think that makes a difference. The other one is we're coming up on the 1-year anniversary of the BTFP. And unless, Powell decides to change the rules and, amend the program, in theory, at least, the banks are going to have to basically repay those loans. So are either one of those two, do you think, material for next year?
I'm not sure about the first one with reverse repo. I'm not an expert on it, and it's something that I'm doing a lot of work on right now. So let's talk again.
Okay, we'll punt on that one, but yeah.
Yeah, I was listening to Powell's comments yesterday about that kind of level of reserves and what it means for QT and how much they'll do, and kind of that right level of whatever they're deciding. So I think I need to do some work on that one, but we'll talk about the BTFP.
Great. And
So,
just so you know, at any point in time, going forward from here, next year, year after, you've done your research on anything that you think is an important message to share with the audience. You're welcome back here anytime.
yeah, that stuff's hard though. So on BTFP, I do think I would put a higher likelihood that they extend it.
Yeah.
Because what do they gain by letting it expire in March? I don't think that they really gain anything.
They might get, they might gain another banking crisis if it's all going to depend on where the price of those assets is at that time.
And they're still going to be underwater because a lot of these assets were bought, in 2020 and 2021 when deposits were surging and yields on the 10-year were 1% and below. So
right.
Even if the 10-year comes down, you're still going to be sitting on some pretty hefty assets or losses, much less than when the 10-year touched 5%. But
Okay.
I do think that the Fed will extend that. They don't need to make the choice to introduce uncertainty for regional banks. And so I think that it's one of those things where it's a crisis policy tool that morphs into a permanent policy tool.
Yeah,
Which
like
is
most
what
of
we've
our.
seen so many times.
There's a quote, it might have been from Reagan, but it was something like, there's nothing more permanent than a temporary government program.
Yeah. And I think that there's some interesting arguments as to why the banks bought so much of that long-term debt and pressure, because of different reserve requirements for the banks, that they were kind of getting pressured into allocating the balance sheet into the debt at the time when Treasury was issuing so much debt to fund all the COVID spending. And so, there's sort of this underground, sort of below the surface idea that they were kind of pushed to put this on their balance sheet. And so the Fed's not going to force them to, kind of eat the spinach of recognizing and marking to market those bonds.
Yeah. And that's a discussion for a different day. But the pickle, or maybe in certain cases, the existential crisis that a lot of these banks found themselves in then was simply by following the Fed script, right? So, the Fed was keeping interest rates low. They had an expectation that would always be the game. They loaded up on quote unquote safe assets. Yep, I'm doing what I'm supposed to be doing. And then the Fed changed the game on them, right? So to your point,
Yeah.
it doesn't necessarily want to penalize them for doing what they thought they should have been doing following the Fed's lead.
I mean, that's such a good point of how many policy pivots where they've gone and done exactly what they said that they weren't going to do. So when, all of us are going, how could they change in 2 weeks? And they just always do.
Yeah.
And what that should lead to though is that we shouldn't feign surprise if they change again. And I don't know if they'll change to a more hawkish tone in an election year in 2024. But you can draw a scenario where you have interest rate cuts in the US that happen to cause dollar weakness, more pronounced dollar weakness, which then causes you to have commodity rallies in energy and food commodities. You also have, because you're easing liquidity or kind of stoking animal spirits, you have continued tightness in the labor force. You have a return back to the lows in unemployment. You then get renewed wage pressure. And what I'm painting a picture is a story where in late 25 or 24, I'm sorry, you're talking about inflation not getting to 2% and getting sticky in that old Arthur Burns stuff.
The Arthur Burns stuff, yeah.
You have a window where inflation's likely going to continue to moderate in the very near term just because of dynamics, base effects, and used car prices and some of the things in housing. But, housing's a great example. Mortgage rates fall, housing inflation comes back, people rush into the housing market again, and maybe you see prices climb and rents start to reaccelerate. And so you can see how this becomes a bit of a challenge to claim victory too soon. If you assume that you could actually see this restoke inflation, maybe not immediately, but in later 24 into 25.
All right. Well, look, real quick on the Fed, maybe expecting them to be inconsistent. It really should be our default, as you're saying. We just had Powell come out on Wednesday and say everything that he said, right? And then we just had this morning, we had the New York Fed President John Williams come out and he said, quote, "We aren't really talking about rate cuts right now." Right. So, Powell having said in early December, we're not even going to think about rate cuts, to saying, oh, yeah, no, of course, it's what we're talking about right now, to then have Williams come out, 48 hours later and say, oh, we're not really talking about it. Right. So there is a lot of inconsistency here. Maybe Williams was sent out there to be a bad cop to Powell's good cop, and they're just trying to manage sentiment. I don't know.
I don't know what they gain by that. Right. What do they gain by having that confusion other than wanting to leave the door open in as many scenarios as possible? It's like they're Silk Sonic, right? Just leave the door open.
I mean, Greenspan just used to like to confuse everybody so that nobody really had a clue, right? But they're more sort of contradictory statements. Maybe it's for the same purpose, but it's much more distracting, I think.
I think the market it appears to be believing Powell more than Williams, though.
Oh, absolutely.
We saw yields pop higher when Williams was speaking and trying to push back against Powell, and then drifted lower through the rest of the day. So we'll see where they close on Friday, today being Friday. We'll see where they close. But, as of right now, I think the market puts more weight on Powell's word, as they should, because he's chair.
And they've been emboldened to, because like we talked about earlier, Powell has always said, I'm going to be higher for longer. The market has doubted, but had to shift, but assets still went up anyways. So the markets are just happy to believe anything that justifies their sentiment that prices should be higher tomorrow than they are today.
And good to remember that a lot of the hawks are no longer on the board. Either they left because of the trading stuff, or Bullard left to go to academia. There's a lot more doves today than there was a couple of years ago, and you can see that in the dot plot. I mean, there's still one lone hawk kind of circling up there on the dot plot, that dot that, just hasn't moved lower in projecting and cuts. But like I said, the balance is towards the doves. The balance is towards the Goolsbys of the world.
Well, and when you look at Fed when you look at the Fed's guidance it's given in the past and predictions it's made about where it expects interest rates to be or inflation to be, record's pretty terrible. So, we shouldn't be putting a ton of weight on that too. But anyways,
And the
I think
bond
the
market's record is terrible as well. I mean, that is worth making a point because a lot of people worship at the altar of the all-seeing 2-year.
Mhm.
And yes, the 2-year yield has sniffed out policy turns. It has, it's been the thing that has driven the Fed, but the 2-year is also wrong a lot, right? So the 2-year, and even we can look at futures pricing at the beginning of 2022, they had rates ending 23, I think, around 2-ish%, ending 22 around 1%. Of course, that's not at all where they ended up, and had to be repriced much, much higher. Of course, that led to some of the weaker markets in 22. But I think it's good to note that the bond market, just as the Fed, is sensitive to incoming data, and things change. And when the facts change, I change, right? And that's the bond market, that's the Fed, and why they do things that are surprising.
Well put. And I think my only last point on this is just sort of markets are going to market until they're beaten. It's painful enough that they start maybe thinking a little bit more rationally. But once sort of the animal spirits get going, they just love to run until something more external tends to start to dampen the party for them.
And watch that
Go ahead.
scenario. Like that scenario for equities is really interesting, right? I was thinking about early 2018 as an example of this. When markets want to market, they run, they have a melt up. If you go back to the first couple months of 2018, markets got really overvalued, and they drifted higher, and nothing was stopping them. They just kept climbing and climbing. You kept going, you're overbought. What are you doing? And it just kept going and going. And what happened is volatility got more and more and more suppressed. People shorting vol, it got coiled and coiled and coiled. Then all of a sudden, boom, we had Volmageddon, and we had, really sharp 1-week period of weakness in the market, that kind of like set off, a very weak trading throughout the rest of 2018. I'm not saying that that's the base case could happen, but I think that investors should be wary of complacency when it comes to positioning, when it comes to sentiment, and when it comes to valuations. And so, watch it really closely, because it may not, it may just be a short period, but if you start seeing people get overextended, overconfident, it tends to work in the opposite direction.
Opposite direction. And I think it's important to note for folks that may not know this, but volatility has been very compressed of late. It's back to very low levels.
12.
Yeah, 12, exactly. Yeah. So, history doesn't always repeat the same way, but it oftentimes does rhyme. So, all right. Well, I want to get to your market outlook and given the sense of current conditions, because things have moved very far, very fast, as you said, sort of what you're counseling people who manage money should be thinking of in this environment. Real quickly, before we do, one big topic, the lag effect, which is something I talk a lot about on this channel. The market seems to have reached the point of view, I think, where it's just said, look, it hasn't happened yet. And I think, the Fed's done a great job of creating this wonderful soft land, just cotton soft landing that we're going to come down on. And the lag effect, I don't think it's going to matter this time around, right? There are others who have said, are you kidding me? Like, we've had one of the most aggressive, increases in rates that we've ever seen. Those are still propagating through time for us. We've totally increased the cost of capital in this world. We've got this maturity wall of all these, corporations that are going to re-rate. We've got tons of consumers that are hanging on by their fingernails right now. How relevant an impact do you think the lag effect is going to have before the story is over?
I think that we all are collectively underestimating the role that the great refinancing wave of 2020 and 2021, plus on the heels of a decade of quantitative easing of ever suppressing interest rates, how that has dampened and delayed the economies and financial markets in incorporation of higher interest rates this tightening cycle. If we look at households and businesses, we can see on net that they are effectively less interest rate sensitive for the largest households and the largest businesses. So the highest income cohorts are the most likely to have a fixed 30-year rate mortgage, but 90% of mortgages are still fixed rate, and the average effective rate of those mortgages is still below 4%. So yes, if you're going out and getting a new mortgage, it's extremely expensive given mortgage rates are still above 7. However, the majority of households have not felt the pain from higher interest rates. You can compare that to prior to the great financial crisis, and 35% of mortgages were floating rate. So the Fed raises interest rates and 35% of homes are seeing their mortgage costs go up, which means that you had people get priced out of their existing homes, and that's why you had foreclosures. That's why you had forced sales. You can tell a very similar story with corporations. You can look at commercial paper, which is short-term paper, as a percentage of overall balance sheets to kind of just compare like commercial paper balances to the corporate ag, for example. And what you can see is that prior to the peaks in 2000 and in 2007, that usage of floating rate debt was extraordinarily high. So as the Fed raised interest rates, people saw their debt servicing costs go up immediately. Of course, we all know we can look at companies who termed out their debt. A third of the, actually it was 2/3 of all of the high yield debt that was issued in 2020 and 2021 was for refinancing. So you had this big, huge refinancing wave when interest rates were so low, which has made refinancing not happen at all pretty much over the last couple of years. I mean, that's why Morgan Stanley and Goldman Sachs are having trouble in their investment banking earnings, right? People aren't doing debt refinancing in the same way as they would typically do. So what will happen is when you get into late 24 and really it hits in 2025, a lot of the debt that was refinanced in 2021 for higher yield borrowers, so lower quality borrowers, does start to mature, and you will have to roll it over. And you will be rolling it over at higher interest rates. The question is, are those higher interest rates enough to truly cause a kind of economic slowdown? It's a good question. I guess we will see. But I would think that, that's why small caps were trading so terribly, right? They're typically high yield borrowers. They do have more floating rate debt. They have more absolute debt. And that's why they're rallying so much, because effectively, there's a sigh of relief that, hey, maybe higher for longer isn't happening. So I would say we shouldn't become complacent either on refinancing, because if you look back, this is the one last point on this, is that if you go back from the beginning of 1980 at the peak of rates in the 1980s, I think the peak was 1982 or 82. The probability of you in a 7-year rolling period, and that's the average maturity of corporate debt is 7 years for investment grade debt. The probability that if you issue debt in year 1 and then refinanced in year 7, 90% of the time from 1982 and through 2023, 90% of the time you were able to refinance your debt at a lower rate, at the lower 10-year rate.
Yep. And
for the first time, that 7-year rolling period, you're now in a period where rates are higher. So, it's Howard Marks' sea change. What is this? What does this mean for financial markets, for what thrived in that environment of ever falling rates and refinancing at lower and lower rates? Does that thrive in an environment where now you actually refinance at higher rates? I think for the very moment today, the market, because it's trading so bold up on this idea of the Fed cutting and interest rates falling, is saying, oh, it's not a problem now because interest rates are coming back down, which makes you think that probably the biggest risk for 2024 is that long interest rates back up. I think that would catch the market the most flat-footed.
By surprise. Yeah.
And you can see positioning, because look, there's something, JP Morgan publishes their client treasury positioning index, and you can see that they are the most overweight long bonds that they've been in a very long time.
Um,
And that B of A fund manager survey has the most overweight to long bonds and the highest reading ever on record of people expecting lower interest rates, not higher interest rates. So not saying it
Okay.
couldn't happen, but it sure is consensus. And if 2023 taught us anything that's consensus likely goes in the other way.
Exactly. When everyone's on one side of the boat, generally something else tends to happen. So in terms of candidates, I know you're not saying this is going to happen or is even likely to happen, but in terms of candidates that would drive interest rates back up, is the number one candidate inflation restoking?
Yeah, I mean, inflation moving higher would certainly challenge the levels of where inflation break-evens are right now. They're really highly correlated to oil prices. You can see break-evens and oil is practically the same chart. So if oil prices rise, as I mentioned, if the dollar falls because the Fed is supposedly cutting and oil prices rise into 2024, then you have a scenario where break-evens, which is, a component of nominal real interest rates, would be biased higher. Then you have Treasury refunding, which we'll have to think about that quarterly refunding announcement. What does that supply-demand dynamic mean for Treasuries if they step up coupon issuance? And then, growth remaining resilient, could argue that the Fed's long-term neutral rate is in fact not 2%, but something higher. And if that's the case, then the long end of the yield curve is biased higher as well. So, I think that, after so many such bruising years of bond performance in 22 and 23, people are really eager to say, now's the time for bonds to shine. Bonds are back.
Mhm.
And I'm not saying like I can tell you a story as to why bonds can be back. But I think that I can also see the risk that yields rise, bonds have another challenging year. And we can't be positioned obviously for both outcomes, but I think we have to be very reactive to the data. Technically, the 10-year is still in an uptrend. It's oversold. It broke below its support on of 4%, which was its 200-day moving average. But that it could be a false breakout. We don't have enough data to confirm it one way or another. And so we're watching this really closely because I think that's the wild card for next year compared to where consensus is. Consensus is so bulled up on bonds.
All right. Yeah, I've had several folks on this program who've been very bullish on bonds, and Dave Rosenberg himself has said the theme for 2024 in his eyes is bonds have more fun. So definitely an argument to be made, but to your point, it's not a slam dunk. All right, so let's now get into your current market outlook as things stand today, poised to heading into the new year. And from a positioning standpoint, are there assets that you think are particularly well suited for the type of road you see ahead, and perhaps are there some assets that you would really avoid given what you see?
Yeah, one of our themes for this year is one of selectivity. And I know that sounds kind of very generic, but it comes from this notion that we think that we're still late cycle, which just means that very low unemployment, interest rates relatively high. Yes, the Fed, might be extending the duration of this cycle because of the interest rate cuts. That's a different debate.
Yep.
But that, that eventually, you'll see, a pickup in unemployment. You'll see like I said, still not a call for the first half of 24, but a late cycle nature to this economy, which just necessitates selectivity. It necessitates good balance sheets, good return on invested capital, good free cash flow generation. Right now, we're seeing a lot of junk rally because of that kind of retirement of the higher for longer risk. But if you see any doubt creep in whatsoever that the Fed's not going to deliver on the 3 rate cuts, and the bond market has 6.5 priced in. So if that doesn't happen, that's where you could see a lot of that junk give up a lot of its recent gains, just like we saw, the small cap rallies this year, and speculative growth rallies this year, 45% rallies gave it all back up. And that really tells you, that sort of late cycle nature of things. So I'm not saying those pockets of the market can't do well. A lot of them very cheap, coiled springs. They can have big runs. They're beta, like high beta. However, I think that being very disciplined around valuation and keeping them on a short leash, knowing you're there to effectively rent the position, not to own the position, would probably be a prudent thing to do, which of course comes with all sorts of tax consequences. So one of the things that we are doing though is we're looking, of course, outside of the Magnificent Seven, for opportunities, for areas that have been beaten up that have lower valuations. Selectivity is key because we've been doing this all year and in our equity portfolios, but we're dipping a little bit lower, even lower into valuations, where we bought a regional bank recently. We hadn't back about 3-4 weeks ago and said, look, it's so bombed out. It has such low expectations. Yield curve is re-steepening for now. And kind of started putting the pieces together, not too much commercial real estate exposure, and kind of going down the line and saying, yeah, a lot of commercial regional banks don't want to touch them, but this one we're willing to invest in. And so I think going through that process of selectivity is critical for us. We do that across asset classes. Fixed income, for example, within credit markets, spreads are very, very tight, which just means you're not being overly compensated for risk at this point, which means that we want exposure to credit. We do have a lot of exposure to credit, but we want to be very conscientious that if you do see any deterioration in data, that credit is likely mispriced. It's not mispriced for the current rate of data being resilient, but if you do see weakness, that's where you would have a challenge. And the same within alternatives. When we think about alternatives, a lot of people saying, private equity is completely dead. The average private equity is really challenged. It thrived in a world where interest rates were low. You could just do financial arbitrage, financial engineering, and it made a lot of people a lot of money. When we look at the opportunity today, what we see instead is that there are funds that are fantastic, that have never used a lot of leverage, are great operators, and are more agnostic to the interest rate environment. And if you think of all the disruption that could happen over the next 2 to 4 years in their investment period, we think that if you can be highly selective, and it typically for us, we focus on smaller funds. We don't like the big mega funds that have the law of large numbers. The opportunity set could actually be interesting. So it's chaos creates opportunity. And even in areas that we would typically avoid with this backdrop, we're saying, where can we, with a very fine-tooth comb, find places where we can invest, with confidence that we're investing alongside some pretty darn good operators.
Okay, great. And have some of those interesting private equity opportunities you're looking at, have they been sort of tarnished with the rest of the sector, so they're sort of trading at a discount in your eye?
Yeah, I mean, it's all brand new funds. That was the other thing, is not wanting to put money to work at valuations that were set back in 2020 or 2021. And what we're seeing is that some of the funds are having trouble, not ones that we're investing in, but a lot of in general is that you see capital raising has slowed quite a bit as people pull back from the space. And I think that what you're starting to see now is valuations for new deals finally start to make a lot more sense. There's been a huge spread between the bid and the ask, meaning that sellers want to sell at valuations that they saw in 2020 and 2021. Buyers want to buy at valuations at today's level and today's interest rates. And the longer you stay in this environment, the more you're going to start getting those forced sales, and you're going to start getting people saying, okay, I have to take action. And that's where being ready with liquidity to step in, these moments can be kind of blink and you miss them. So, it's a lot of valuation discipline. It's a lot of making sure that leverage is very, very controlled, and that the return is not dependent on leverage, not dependent on what the Fed does. It's actually things that are idiosyncratic and kind of own your own destiny.
All right, great. Last question on this. You mentioned commodities a couple times, probably likely to benefit from the expected path of the Fed from here over time. What's your take on them for next year?
Yeah, I think a lot of it depends on the dollar. The dollar being, such an important driver, of commodities over, longer periods of time. We see it diverge at different moments, but a much weaker dollar likely does set the stage for higher oil prices, possibly higher ag prices. You talk about gold a little bit differently, which we can. The gold story, in being a psychological commodity, like some of the crypto as well, is if you're painting a story where you have a lot of issuance of treasuries, which gets people concerned about dollar debasement, whether it's true or not, it's the emotion and the fear of it that can drive the price of psychological commodities. um, at the same time as you have Fed cutting interest rates and adding liquidity, where you get real interest rates falling, which are typically good for gold and other psychological commodities. You can paint a picture as to how they could do well in that environment of more abundant liquidity, lower interest rates, and a weaker dollar. Of course, a lot of other things are components and drivers of that, but that's something I think for people to keep in mind. And then on the oil side of things, you just have people so bombed out in the sector after it being so weak. Flows have been aggressive out of energy sector. A lot of people, giving up on the space, generalists giving up on the space. So seems like a pretty low bar to jump over, but you still have excess supply effectively in oil. And it's a question of, could Saudi actually pull a 2014? I remember it was Thanksgiving Day on 2014, and they announced instead of cutting oil production because prices were too low, they increased production, trying to smoke out the frack drillers. Of course, it didn't work. It quite gloriously blew up in their face, but don't rule that out as a kind of a potential thing that could drive oil prices much lower before they would continue higher.
All right. Thank you so much, Cameron. There are some big questions that I didn't get to that I would love to ask you the next time we have you on the program. Housing, big one. You touched on a little bit, but I'd love to get your more detailed thoughts on that. And something else, just as a little bit of a preview, but when we talk about the wealth effect, you increase financial assets, and then people who benefit from that want to spend more. We increasingly have this economy where the percentage of households that own the vast majority of financial assets is an increasingly small percent. So we sort of have this world, at least from the data I look at, is that kind of the bottom 90% seems to be getting sort of increasingly squeezed by our current policies here, whether that's intentional or unintentional. We don't need to get in there right now, but I would love to, at some point in the future, get your thoughts about sort of the trajectory that we are pursuing right now. What are the social implications of that? Maybe it's not as dire as some are making it out to be, or maybe it is. I don't know. And I'm not asking you to tip your hat here yet. I just want to let you know I would love to get your thoughts on that in a future discussion. Two last questions for you here as we wrap up. The first very important one, which is for people who have really enjoyed this conversation, maybe this is the first time they're getting to know you. If they'd like to follow you in your work, where should they go?
You can find me on X at Cameron Dawson, and then I'm also on LinkedIn where I share things as well. And that if you just Google or search Cameron Dawson, you should see me pop right up.
Okay. And when I edit this, Cameron, I will put up the URL to your X handle there, and also your name, so that people know exactly what to Google. Folks, I'll put them in the description too, so you can have one-click access to that if you want. All right, the next question I'm going to get to in just a second, but it's going to be, what is a non-financial investment that you would encourage folks to invest in? Real quick before we do that, just a little bit of housekeeping. One, folks, if you've enjoyed having Cameron come on this program, would like to see her come back on in the future, please vote your support for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And a reminder that while this channel is still so new, the growth in our subscribers really does help us catch the YouTube algorithm's attention. So please do hit that subscription. It's totally free. Also, just want to remind folks, if you want to get my notes to these interviews, my detailed summaries of what I took away from them, including this one with Cameron, just go to my Substack. And if you subscribe there, become a premium subscriber, you'll get all my notes. To go there, just go to adamtaggart.substack.com. All right, Cameron. So in wrapping up here, giving you the last word, what's a non-financial investment that you think would be wise for folks to consider right now?
Read more books. I think that it's very easy to get caught in the day-to-day of reading articles and short form content, but the ability to read something that didn't take 2 hours to write, but maybe took 2 years to write, and the thought process behind that, the ability to read, history so that you have context, things outside of what you're focusing and looking at on a day-to-day. I think that spending time reading books is the best thing that you can do for your broader mindset, your perspective, and I think your career, life, joy, happiness, all of the above.
All right, wonderful answer. Totally validating coming from somebody sitting in front of a bookshelf. So you definitely practice what you're preaching here. Cameron, a similar comment was raised the other day by Axel Merck, who brought up a really good point, which I think you're making here, which is books to write a book, you have to have a framework. You have to have a way to think about something, and that's what the book is basically imparting to the reader. And there's a lot of value in seeing the world through alternative frameworks and determining which ones you think are maybe closer to reality or not. And oftentimes, when we're just reading an article that took somebody 2 hours to write, right, versus 2 years, or even worse, we're just skimming the headlines, or we're just consuming on the worst of social media. We're not getting that. We're not being exposed to frameworks, and so the book gives you the opportunity to do that. So, anyways, great point. I really appreciate you sharing that here. I love the answers we're getting to this new question. Cameron, it's just been an absolute joy. Thank you so much for coming on. Like I said, doors open to you to come back on anytime in the future, but I hope at some point in relatively early 2024, we can have you back on and maybe get into some of those other topics I mentioned, but also just give us an update on where you see things between here and there, depending upon what's happened.
I would be beyond honored. Thank you so much for having me.
All right, thanks so much. Everybody else, thanks so much for watching.